What are you saying, guys? Today I want to talk about the recent Bitcoin crash and the Wycoff pattern. So let's dive on in. Wycoff was a stock trader back in the 1930s who realized that retail traders were being repeatedly fleeced through institutional market manipulation. They do this by scaring the average trader into selling their stock. We need to see this as a good thing because if prices continue to rise, it can become unsustainable, so a crash is required to extend the length of the bull run, which is what institutions want. The reverse is also true. If prices continue to crash, then institutions will bring out bullish news and start pumping the price again. The best example of this is Elon Musk no longer accepting BTC as payment for Tesla products due to environmental reasons that he somehow didn't know about when he bought it. We then see him tweeting about Tesla having diamond hands very close to the bottom. A lot of people are scared of a bear market and worried the bull run is over. I'm here to tell you it is not over. We are just entering an accumulation stage while we cool off for the next leg up. I predict that we will move sideways between 27k and 42k until September October time, but by the end of this bull run we will see a 100k Bitcoin. This will be important as we know Bitcoin is king and affects the market as a whole. We are not going to see a V-shaped recovery from this crash, and we are not going to see a further drop to 15k. People are being overly bullish and overly bearish based on their own bias. Institutional traders simply won't allow either of these things to happen. So let's have a look at the chart. I first want to look at the past 4 months of BTC pattern to help us predict where BTC is going next. The past 4 months clearly follow the Wyckoff pattern. First, we start off with a preliminary supply where we see people begin to anticipate an uptrend approaching. We move on to the BC, which is the buying climax. This is where we see many inexperienced traders coming in due to hearing bullish news and wanting to join in. This is when we start to see institutional traders sell their assets to the inexperienced traders. This is known as the automatic reaction. Once prices start to get too low, institutions will ease off as retail investors start buying the dip. This creates the secondary test, or ST. This starts phase B, where institutions are now gradually selling to the retail investors. What we will see here is institutions trying to keep confidence high while they look around, check there's no cameras, and then sell. This creates a sign of weakness and UT points in the diagram. The sign of weakness is when supply starts to become dominant over demand, and the up thrust is from institutions keeping confidence high by bringing out bullish news. We see more and more of this news so they can get as many retail investors to buy in as possible through fear of missing out, and then institutions begin ramping up their selling, which will cause a price fall due to increased supply. We will then see the last point of supply, which only indicates that the market is having difficulty advancing. This is followed by another sign of weakness that is just below the support line. The Wyckoff method does lose its shape a bit here, but was kicked back into shape by Elon calling the spirit bomb and China's ban on BTC mining. Phase E of this pattern will usually do the fusion dance with phase A of the accumulation schematic, which allows the market to go on its next leg upwards. This whole pattern allows institutions to sell large amounts of supply while keeping retail investors interested. Now I want to look at the accumulation schematic to predict where we are heading next. We start off with the preliminary support again, where after such a fall people begin buying again, signaling the downtrend is coming to an end. Next we have the SC, otherwise known as the selling climax. This is when prices have gotten so low that people start panic selling due to prices being so low. The buying pressure will then be absorbed by institutions such as ARK Invest, which bought heavily during this time. This will cause an AR, or automatic rally, which will then be followed by a secondary test as retail investors, scared by the recent fall, will see their chance to exit with a higher liquidity. Phase B will consist largely of an accumulation stage. We can see 3 points where we fall out of the resistance and support lines, here, here, and here, as institutions want to keep the retail investor uncertain about re-entering the market. In phase C, we will see a larger dip, and in which institutions will try to take any assets that they couldn't take during the first 2 phases. Now, finally, we get to the good news. In phase D, the price will start bouncing, but we could see 1 or 2 corrections where we see the last point of support. The difference between the last point of support and an ST is that the last point of support will have a much lower selling volume. Moving on to the SOS or sign of strength, this will act as the signal that price will continue to move into an uptrend that we are all hoping for. And then we'll see phase E and then back to the moon. A reason this may not play out is because a lot of people are learning about this Wycoff pattern and institutions won't be able to execute it as successfully anymore. But this is all just a theory, and I hope you guys enjoyed, and I'll see you next time.